Welcome to our comprehensive USD/CAD analysis for November 3rd through 8th, 2025. In this presentation, we'll examine one of the most significant moves in the US dollar-Canadian dollar pair in recent months. During this critical week, the pair surged to 7-month highs before pulling back, creating important trading opportunities. We'll analyze the technical levels, fundamental drivers, and provide actionable trading strategies for both short-term and medium-term timeframes. Whether you're a day trader or swing trader, this analysis will equip you with the insights needed to navigate the current USD/CAD market. This report was prepared on November 10th, 2025, using data from TradingView, Investing Live, Action Forex, Forex.com, and Daily Forex. Let's dive into the analysis. The USD CAD pair delivered an impressive 6-day rally from November 3rd to 8th, reaching 1.4140 on November 5th, the highest level since April 2025. This remarkable surge was driven by hawkish Federal Reserve policy signals and widening interest rate differentials favoring the US dollar. The rally originated from a failed breakdown below the 50% midpoint at 1.3903, which triggered renewed buying interest. Following the FOMC rate decision, which was perceived as less dovish than anticipated, momentum accelerated significantly. The pair reclaimed positions above both the 100-hour and 200-hour moving averages, confirming bullish momentum. However, by November 8th, the pair had pulled back to 1.40462, down 0.51% from its peak, suggesting potential short-term exhaustion after the extended rally. Three major economic developments shaped USD/CAD's volatile week. First, Canada's October employment report on November 7th delivered a significant surprise, adding 66,600 jobs, far exceeding market forecasts. This robust labor market performance lifted the Canadian dollar and caused USD/CAD to retreat from its 7-month highs. Second, divergent central bank policies created a favorable interest rate differential for the US dollar. The Bank of Canada cut rates by 25 basis points to 2.25%, signaling the potential end of their cutting cycle, while Fed Chair Powell adopted a hawkish tone, indicating future rate cuts are not guaranteed. Third, strong U.S. economic data provided additional support for the dollar. The ADP employment report beat forecasts, and ISM Services PMI delivered stronger than expected readings, with the price index reaching a new cycle high. Understanding key technical levels is essential for successful USD/CAD trading. On the resistance side, we have 6 critical levels. 1.4140 marks the recent high and immediate resistance, followed by 1.4166, representing the 50% retracement of the 2025 trading range. Above that, 1.4176 is a swing level, while 1.4250 represents a previous supply zone and major upside target. Extended targets sit at 1.4295 and 1.4312. The latter being the 61.8% retracement level. For support, 1.4080 is critical support, where the recent high has turned into support. The 55 4-hour EMA sits at 1.4054, followed by the psychological 1.4000 level. Major trendline support is at 1.3950, with critical support at 1.3886, and key support at 1.3725. A potential double shooting star formation at the 1.41 level suggests short-term exhaustion. The short-term outlook for USD/CAD has shifted to mildly bearish following the 6-day rally. The pair has pulled back from its 7-month high of 1.4140, closing at 1.40462 on November 8th. The break below the 55 4-hour EMA at 1.4054 suggests that a short-term top has formed. In the bearish scenario, which carries higher probability, traders should look for an initial target at the 1.4000, to 1.4050 support zone, with an extended target at 1.3886 if support breaks. Entry would be on rallies toward 1.4100 to 1.4140 resistance, with stop loss above 1.4150. The alternative bullish scenario requires a break above 1.4140 to resume the rally, targeting 1.4250 to 1.4295, with entry on breakout and stop loss below 1.4080. Key events to watch include US CPI data, Canadian economic indicators, and Federal Reserve communications. Looking at the medium-term outlook for 1 to 3 months, price action from the 1.4791 medium-term top continues to unfold as a correction to the uptrend from 1.2005, the 2021 low. The rise from 1.3538 represents the second leg of this corrective pattern, with a third leg anticipated before the uptrend resumes. We expect USD/CAD to trade in a range between 1.3886 and 1.4312. The bullish scenario carries 60% probability, assuming the Fed maintains its hawkish stance, the Bank of Canada keeps rates steady, and US-Canada trade tensions persist. The strategy would be to buy on dips toward 1.3886 to 1.3950, targeting 1.4250 to 1.4312. The bearish scenario at 40% probability would require stronger Canadian economic data, Fed signaling more rate cuts, or trade dispute resolution. The risk-reward ratio for range-bound trades is approximately 1 to 1.5 to 1 to 2. The interest rate differential between the United States and Canada continues to favor the US dollar, with no indication of this dynamic changing in the near term. The Federal Reserve maintains a hawkish stance, limiting rate cut expectations. Market pricing currently shows a 65% probability of a December rate cut, down from higher expectations previously. Persistent inflationary pressures, evidenced by the ISM Services Price Index at a cycle high, support this hawkish stance. Treasury yields are rising, further supporting USD strength. Meanwhile, the Bank of Canada recently cut rates by 25 basis points to 2.25%, the lower bound of their neutral range. Their forward guidance states, the current policy rate is about the right level, though they maintain flexibility for another cut if needed. Additionally, a persistent global US dollar shortage continues to support the greenback, independent of domestic monetary policy considerations. Trade dynamics between the US and Canada create a structural advantage for the US dollar. Canada sends approximately 75 to 80% of its exports to the United States, while the US exports relatively little to Canada in return. This fundamentally asymmetric relationship structurally favors the US dollar during times of trade uncertainty. Currently, ongoing trade tensions between the two countries continue to weigh on the Canadian dollar. Lingering uncertainty following negotiation setbacks and speculation that Canada may lag economically add pressure to the currency. The interconnected nature of the two economies makes it nearly impossible to disconnect them in the short term. Yet the trade tensions are expected to increasingly pressure the Canadian dollar as they persist. Additionally, Canada's federal budget deficit is forecast to rise to $70 to $100 billion from $42 billion projected a year ago, raising concerns about fiscal credibility. Understanding both upside and downside risks is crucial for successful trading. Upside risks for USD/CAD include a more hawkish Federal Reserve than currently priced, escalating US-Canada trade tensions, sharp declines in oil prices, deteriorating Canadian economic data, and widening fiscal deficits in Canada. Downside risks include stronger than expected Canadian economic data, like the November 7th jobs report, a more dovish Federal Reserve pivot, resolution of US-Canada trade disputes, sharp rallies in oil prices, and unexpected Bank of Canada hawkish shifts. For trading discipline, follow these 5 essential recommendations. First, maintain strict stop losses with single trade risk not exceeding 2% of your account. Second, avoid heavy positions in a single entry. Third, closely monitor central bank decisions and key economic data. Fourth, flexibly adjust your strategy to market changes. Fifth, target a minimum 1 to 1.5 risk-reward ratio on all trades. Let's summarize the key takeaways from our USD/CAD analysis. First, the pair rallied to 7-month highs at 1.4140 during November 3 to 8, driven by hawkish Fed policy and interest rate differentials. Second, the pair has pulled back to 1.40462, with technical indicators suggesting short-term exhaustion after the 6-day rally. Third, the short-term outlook is mildly bearish, with an initial target at 1.4000 to 1.4050 support zone, and a break below could extend to 1.3886. Fourth, the medium-term outlook anticipates range-bound correction between 1.3886 and 1.4312 as part of a larger uptrend structure. Fifth, key drivers including interest rate differential, U.S.-Canada trade tensions, and monetary policy divergence continue to favor USD strength. Finally, the recommended trading strategy is to buy on dips toward support zones and sell on rallies toward resistance, while maintaining strict risk management. Remember, market conditions can change rapidly, so stay informed of economic data releases and central bank communications.